Something shifted in the silver market recently, and if you hold this metal or have been considering it, you need to understand what's actually happening beneath the surface noise. I'm not here to sell you hype. I'm not here to promise you riches by next Tuesday. What I am here to do is walk you through a significant development in the precious metal space with the same clarity and restraint you'd expect from a trusted advisor sitting across the table from you. Silver prices have demonstrated unusual volatility in recent weeks, breaking through resistance levels that held firm for months, then retreating, then surging again. For casual observers, this looks like chaos. For those who understand market structure and the forces that drive commodity cycles, this looks like something else entirely. This matters whether you currently hold silver or not. It matters because the mechanisms creating this volatility aren't isolated to one metal. They're symptoms of larger structural pressures building across the financial system, pressures that have been accumulating for years and are now expressing themselves in ways that demand attention. Today, we're going to examine what's happening, why it's happening, what history tells us about moments like this, and most importantly, how thoughtful investors navigate uncertainty without losing their discipline or their capital. No predictions, no guarantees, just clarity. Let's start with what actually changed. Over the past several weeks, silver experienced sharp price movements that broke the relative calm it had maintained through much of the previous months. These weren't subtle shifts. We saw intraday swings that would typically take weeks to unfold, compressed into hours. The immediate trigger points toward a combination of factors: shifts in industrial demand expectations, movements in currency markets, and most significantly, changes in how institutional players are positioning themselves in precious metals broadly. But here's what most commentary misses. The catalyst isn't the story. The catalyst is simply the match. What matters is the kindling that's been stacking up, the structural conditions that make a market ready to move explosively when the right trigger arrives. Silver doesn't move like this in a vacuum. When you see this kind of volatility in the metal space, you're watching the intersection of multiple powerful forces: monetary policy, uncertainty, industrial demand dynamics, investment demand shifts, and the mathematical reality of a market that's relatively small compared to the capital that can flow into it. Think about that last point for a moment. The entire silver market, in terms of above-ground investment supply and annual production, is tiny compared to gold, let alone equity or bond markets. When large capital begins repositioning toward tangible assets, even modest flows can create outsized price effects in silver. This isn't manipulation. This isn't conspiracy. This is market mechanics, pure and simple. Here's where most investors go wrong when they watch silver move like this. They treat it as a standalone story. They look for silver-specific news, silver-specific catalysts, silver-specific narratives. And while those elements exist, they're focusing on the branches while missing the forest. Silver is simultaneously an industrial metal and a monetary metal. It's used in solar panels, electronics, and countless manufacturing applications. It's also held as a store of value, a portfolio hedge, and a tangible alternative to paper currency systems. This dual nature means silver responds to two different sets of forces, often at the same time. When both sets of forces align, when both industrial demand expectations and monetary concerns point in the same direction, silver can move with breathtaking speed. Most people missed this alignment happening over the past year. They saw stable prices and assumed nothing was changing. Meanwhile, beneath the surface, the setup was building. Central banks globally have been buying physical gold at rates not seen in decades. Why? Because they're diversifying away from dollar reserves, hedging against currency risk, preparing for a world where monetary certainty is less certain than it's been in generations. When central banks do this, they're not speculating. They're responding to risk calculations at the highest levels of the financial system. And while they focus on gold primarily, the same concerns that drive gold accumulation eventually flow into silver, particularly when gold reaches price levels that make silver look relatively cheap. At the same time, industrial demand for silver continues growing, driven by the energy transition, technological advancement, and the simple physics of a metal that conducts electricity and heat better than any other element. Supply, meanwhile, faces constraints. Most silver comes as a byproduct of other mining operations. You can't simply open a pure silver mine overnight when prices rise. There's lag time, development costs, geological limitations. So we have growing demand from two directions: supply that can't respond quickly, and a market small enough that repositioning by large players creates visible price effects. That's the forest. The recent volatility, that's just wind in the trees. Now let's zoom out further and look at the economic conditions surrounding this moment. We're living through the aftermath of the most dramatic monetary expansion in modern history. In response to the 2020 crisis, central banks created more currency in 2 years than they had in the previous decade. That's not opinion, that's mathematical fact. Where did that currency go? Into asset prices, into real estate, into equity markets. into the hands of those positioned to benefit from cheap money and expanding credit. Now those same central banks face a dilemma. Inflation proved not to be transitory. It embedded itself in the cost structure of the economy. Food, energy, housing, services, all repriced higher, and those prices haven't come back down, even as the rate of increase slowed. Central banks responded by raising interest rates, attempting to cool demand without triggering recession. It's an impossibly delicate balance, and history suggests they rarely stick the landing perfectly. Here's what this means for assets like silver. When confidence in currency stability wavers, when people look at debt levels exceeding 120% of GDP in major economies, when they see unfunded liabilities stretching into the tens of trillions, when they watch the purchasing power of their savings erode annually, they seek alternatives. Not everyone, not all at once, but enough people with enough capital to matter. This isn't new. This pattern has repeated throughout history. Currency debasement leads to flight toward tangible assets. It happened in Rome, it happened in Weimar Germany, it happened in the 1970s. The details change, but the pattern remains consistent. We're not in hyperinflation. We're not in a currency collapse. But we are in a period where the mathematical certainties of debt, deficit spending, and monetary creation are colliding with political reluctance to make hard fiscal choices. Something has to give. The question isn't if, but when and how. Investors who understand this aren't panicking. They're positioning. They're recognizing that periods of monetary uncertainty favor assets that can't be printed, can't be created by policy, and have maintained value across centuries. Silver fits that description. So does gold. So do other tangible assets. But silver offers something unique, industrial necessity combined with monetary properties, all in a market small enough to amplify the effects of capital flows. Let's talk about what history actually teaches us about precious metals during periods of monetary stress and economic transition. If you go back and study the 1970s, you'll see a pattern that feels uncomfortably familiar. You had an energy crisis, you had high inflation, you had a loss of confidence in monetary stability, you had government debt growing relative to economic output. In that environment, gold went from $35 an ounce to over $800 by 1980. Silver went from under $2 to over $50 in the same period. But here's what most people forget when they cite those numbers. The path wasn't straight, it wasn't smooth. There were brutal corrections along the way. In 1974, gold fell 40% from its highs before resuming its advance. Silver experienced even more volatility. The investors who succeeded weren't the ones who bought the exact bottom or sold the exact top. They were the ones who understood the structural forces at play, maintained their positions through volatility, and didn't let short-term price swings shake them out of their thesis. They weren't lucky. They were prepared. They were educated. They understood that markets move in waves, not straight lines, and that the most dramatic gains often come in the final stages of a cycle, after everyone else has already lost patience. Now, we're not in the 1970s. The economic structure is different. The monetary system is different. Technology is different. But the underlying human behaviors haven't changed. The way markets respond to currency concerns hasn't changed. The mathematics of supply and demand haven't changed. When you study market history across centuries, certain patterns emerge. Precious metals spend long periods doing very little, lulling people into believing they're irrelevant relics. Then, relatively suddenly, they wake up, and years of price compression release in months. We saw this in 2011, when gold went from under $300 to over $1,900. We saw silver go from under $5 to nearly $50. Then, we saw both metals endure a brutal bear market from 2011 to 2015, followed by years of consolidation. What's happening now may be the early stages of the next major cycle, or it may be a false start followed by more consolidation. Nobody knows for certain. But what we do know is this. The structural conditions that drive secular bull markets and precious metals are present. Debt is higher than it's ever been. Deficits show no signs of shrinking. Central banks remain trapped between inflation concerns and recession fears. Geopolitical tensions are elevated. Currency confidence, while not broken, is more fragile than most people realize. In that environment, the probability of precious metals entering a sustained bull market increases. Not certainty, probability. Now let's talk about something equally important, but less discussed. The psychology that drives market cycles. Every asset class moves through predictable psychological phases. First comes disbelief, when prices start rising, but everyone assumes it's temporary. Then comes awareness, when more participants notice the trend. Then comes enthusiasm, when the narrative spreads. Finally comes euphoria, when everyone believes prices can only go up. Silver is nowhere near euphoria. In fact, most people still view precious metals with skepticism or indifference. That's actually a bullish indicator for those who understand cycles. The best opportunities in any market come during the disbelief phase, when prices are moving but sentiment remains negative or neutral. That's when risk-reward ratios favor patient investors. By the time everyone's excited, by the time your relatives are asking how to buy silver at dinner parties, by the time mainstream financial media is breathlessly covering every uptick, you're closer to the end than the beginning. Right now, we're seeing something interesting. We're seeing price volatility increase while mainstream attention remains limited. We're seeing institutional positioning change while retail sentiment stays cautious. This disconnect is significant. It suggests smart money is repositioning while public attention is elsewhere. That's precisely the environment where major market moves begin. But here's the critical point. Understanding this doesn't mean blindly buying. It means recognizing where we are in the cycle and adjusting your approach accordingly. If you're already holding silver, this context should reinforce your patience. Volatility isn't something to fear. It's the natural byproduct of a market transitioning from one phase to another. If you're not holding silver, this context should encourage education before action. Understanding why an asset might appreciate is far more important than trying to catch a specific price level. The investors who succeed over decades aren't the ones who time everything perfectly. They're the ones who understand probability, manage risk appropriately, and don't let short-term volatility override long-term strategy. First, the recent volatility validates your thesis. You didn't buy silver because you expected smooth, predictable appreciation. You bought it precisely because you understood that when the structural forces align, this market can move dramatically. Volatility is not your enemy. Volatility is the mechanism through which major repricing occurs. If silver moved smoothly and predictably higher, institutional capital would arbitrage away the opportunity. The fact that it moves violently in both directions is precisely what creates the potential for substantial returns. Your job right now is simple. Stay educated, stay patient, and don't let price swings dictate emotional decisions. If you bought silver as portfolio insurance, as a hedge against monetary instability, then short-term price movements are largely irrelevant. Insurance doesn't become more or less valuable based on daily price quotes. It becomes valuable when the conditions it protects against materialize. If you bought silver as a long-term store of value, then your time horizon should stretch across years, not weeks. The path matters less than the destination, and the destination depends on factors that unfold over extended periods. If you bought silver as a speculation on a new bull market, then volatility should be expected and tolerated. Speculative positions by definition carry risk. The trade-off is potential for substantial returns if your thesis proves correct. What you should not do is check prices constantly, react to every headline, or allow short-term noise to override the reasoning that led you to establish the position in the first place. The hardest part of investing isn't buying. It's holding through the volatility that inevitably follows. Most people lose money in markets not because they picked the wrong assets, but because they sold the right assets at the wrong time. If your circumstances haven't changed, if the thesis remains intact, if you haven't overextended yourself financially, then the recent price action is simply confirmation that the market is alive and active. Stay the course, stay informed, stay disciplined. The first thing I'll tell you is this: never chase price. Never buy an asset because it moved recently. Never enter a position out of fear of missing out. Those approaches lead to emotional decisions, poor entry points, and eventual regret. If you're considering silver, your first step isn't buying, it's education. Why does silver behave the way it does? What role would it play in your overall portfolio? How much volatility can you tolerate without panicking? What's your time horizon? These questions matter more than any price chart. For most people, precious metals should represent a minority allocation within a diversified portfolio. 5 to 10% is common. Some aggressive investors go higher. Conservative investors might go lower or skip them entirely. There's no universal right answer. It depends on your situation, your goals, your risk tolerance, and your beliefs about where the monetary system is headed. If you decide silver makes sense for you, then the approach should be methodical. Start small. Learn how the market behaves. Understand the difference between physical metal, ETFs, mining stocks, and futures. Each has different characteristics, different risks, different tax implications. Physical metal offers ultimate security, but comes with storage considerations and premiums over spot price. ETFs offer liquidity and convenience, but carry counterparty risk. Mining stocks offer leverage to metal prices, but carry company-specific risks. Know what you're buying and why. And here's something critical. Don't assume recent price action means you've already missed the opportunity. If this is indeed the beginning of a major cycle, then we're in the early innings. If it's a false start, then patience will be rewarded with better entry points later. The worst thing you can do is rush into a position without understanding it, without having a plan, without knowing how you'll respond when volatility inevitably arrives. Take your time. Do the work. Build conviction through understanding, not through excitement about recent price moves. Let me be very direct about the mistakes I see people make in markets like this. Do not over-leverage. Do not use borrowed money to buy silver. Do not bet the farm. Do not risk capital you'll need for living expenses. Leverage amplifies gains, yes, but it also amplifies losses. More importantly, it forces you to react to short-term price movements because you can't afford to wait out volatility. That's how people lose everything. Do not chase price momentum without understanding what you're buying. Just because silver went up yesterday doesn't mean it will go up tomorrow. Markets move in both directions, often violently, and timing is impossible to consistently get right. Do not follow online hype uncritically. Social media is filled with people making bold predictions, sharing sensational headlines, and promoting various narratives. Some are well-intentioned but uninformed. Others have agendas. Very few have your best interests at heart. Do not assume you can outsmart the market by trading in and out. The most common mistake I see is investors selling during corrections with plans to buy back lower, then watching prices run away from them. Transaction costs, taxes, and mistimed decisions erode returns faster than almost anything else. Do not ignore the rest of your financial life to focus obsessively on silver prices. You still need emergency savings. You still need appropriate insurance. You still need retirement planning. You still need diversification. Silver might be important. It's not everything. Do not confuse volatility with risk. They're related but different concepts. Volatility is price fluctuation. Risk is permanent loss of capital. In markets like precious metals, volatility is the norm. It's not a sign something's wrong. It's a sign the market is functioning. And finally, do not make investment decisions based on fear or greed. Both emotions are terrible advisors. Fear makes you sell at bottoms. Greed makes you buy at tops. Discipline, patience, and education make you money. We're living through a unique moment in financial history. We have debt levels that would have been considered impossible a generation ago. We have monetary experimentation on a scale never before attempted. We have geopolitical fragmentation accelerating. We have technological change disrupting established industries. In this environment, certainty is expensive. The old playbook of buying government bonds for safety and stability doesn't work the way it once did when those bonds yield less than inflation. This doesn't mean the system is collapsing. It doesn't mean we're heading for Mad Max scenarios. It simply means we're in a period of transition where the rules are being rewritten, where old assumptions are being tested, where the margin for policy error is narrower than it's been in decades. Silver, gold, and other tangible assets have historically served as ballast during such periods, not because they produce income or dividends, but because they maintain purchasing power when confidence in paper systems wavers. That's not speculation. That's observation based on centuries of market history. And what we're seeing in silver prices lately is simply the market beginning to reprice that reality. The volatility, the sudden moves, the uncertainty, these are all symptoms of a market that's transitioning from one equilibrium to another. Where it ends, nobody knows. How long it takes, nobody knows. How volatile the path will be, nobody knows. But what we do know is that investors who understand these dynamics, who maintain discipline, who don't panic during corrections or get euphoric during rallies, tend to do well over time. Silver is experiencing unusual volatility because structural forces that have been building for years are now expressing themselves in price action. This isn't random. This isn't manipulation. This is markets doing what markets do when underlying conditions change. For those who hold silver, this is validation, not cause for panic. Your thesis is being tested in real time. Volatility is the price of potential appreciation. Stay patient, stay educated, stay disciplined. For those considering silver, this is an invitation to do the work. Not to chase prices, not to rush in blindly, but to understand what role, if any, precious metals should play in your portfolio and to act accordingly. For everyone, this is a reminder that we're living through economically interesting times. The decisions being made by central banks, governments, and market participants today will echo for years. Understanding those dynamics matters more than trying to predict tomorrow's price. I opened this video by saying something shifted in the silver market. That's true. But the deeper truth is that something is shifting across the entire financial landscape. Silver is just one symptom, one expression of those broader changes. The investors who navigate this period successfully won't be the ones who make perfect trades. They'll be the ones who understand probability over certainty, who value education over speculation, who maintain emotional control when others panic or euphoria. They'll be the ones who recognize that markets move in cycles, that opportunity often appears during periods of maximum uncertainty, and that patience, combined with knowledge, is the most powerful advantage any investor can possess. Silver's wild ride isn't over. In fact, it may just be beginning. But that's not something to fear if you're prepared. It's not something to chase if you're not. It's simply the market doing what markets do, reflecting the underlying realities of supply, demand, monetary conditions, and human psychology. Your job is to stay informed, stay rational, and make decisions based on understanding rather than emotion. This isn't about getting rich quick. It's about protecting and growing wealth over time by understanding how the financial world actually works. That knowledge, that perspective, that discipline, those are worth more than any price prediction I could ever give you. Stay educated, stay patient, stay thoughtful. And remember, the best investment you can make is in your own financial understanding. Thank you for watching.